All right, we know a little bit about options, but what are the three things that make up an options premium or an options value? Well, I'm going to break those three things down in this video for you. Hey guys, my name is Tim. I'm the head trader and founder here at Option Legacy, helping you build a legacy through trading. Let's hop over into my resource here that I created for you. It's absolutely free. It's called the Lingo Cheat Sheet. One of the hardest things that I found whenever I began learning stock options was just simply the terms. The way I felt whenever people were talking to me about stock options was it was like a French man teaching me how to bake a French croissant in French, and I've never been to France or knew a lick of French. I was like, what are you talking about? And so how do you get over that? Well, the easiest way to learn a language is simply by what? Submersion. So I created this Lingo cheat sheet as just that, a cheat sheet for you in the most common terms that you can find. So you can get that in a link around this video. Go ahead and get it if you have not already. So what are the three things that make up an options premium or its value? It's one, it's intrinsic value. Two, it's implied volatility. And three, it's theta or time decay. Theta and time decay can be interchangeable. So let's break these things down, and again, you'll have this resource to read over as many times as you want. And then we'll go over into the option chain itself and break down an options premium using these three aspects. Intrinsic value is the value of call option. Intrinsic value for a call option is the difference between the underlying stock's price and the strike price. Conversely, on the other side of things, the intrinsic value for the put options is the difference between the strike price and the underlying stock price. You notice how they're the same? Just calls are on one side, puts on the other side. In case of both calls and puts, if the respective difference value is negative, the intrinsic value is given as 0. Intrinsic value intrinsic value and extrinsic value combined make up the total value of an option's price. The extrinsic value of time value takes into account the external factors that affect an option's price, such as implied volatility and time value. So we have intrinsic value, and then that makes up one aspect of the options premium. The other two is called implied volatility and theta, and those are also known as extrinsic value. So implied volatility is the estimated value of the underlying security. Understand here, it's the estimated value. Implied volatility is driven by supply and demand is one of the deciding factors of pricing an option. Implied volatility approximates the future value of an option. An option's current value takes this into consideration. It's important to remember that implied volatility is all probability. It's only an estimate of future prices rather than an indication of them. So did you see there we said a lot about indication, estimate, things like that. So it's not a hard fact, it wiggles around, and we can use that in our advantage going forward. I'll break that down in future videos. Theta is the measure or the rate of decline in the value of the option due to the passage of time. It can also be referred to as time decay on the value of an option. If everything were to be held constant, intrinsic value and implied volatility were to stay still, the option would lose value as time moves closer to the maturity or the expiration of the option contract. Woo! I know I'm throwing a lot out you, so you got to go get this resource and read it on your own. But let's hop into a broker platform and look at the option chain and break down an options premium. So again, the three things that make up an options premium is intrinsic value, implied volatility, and time decay. So we're looking at XLF. This is a spider of the financial sector inside of the S&P 500. So let's look at the 26 strike right here and the value of this call option. It's at 90 cents. And since we know that the intrinsic value is the difference between the strike price and the price of the underlying security, we can say that we'll call it 65 cents just for easy math. 65 cents of this 90 cents is made up of intrinsic value. The way we found that was we used this strike price, we minused it from the price of the underlying security. That difference is, for easy math, we're saying 65 cents. So 90 minus 65 is 25 cents. So what makes up, if this thing is going for 90 cents, and we know that 65 cents of it comes from intrinsic value, what makes up that other 25 cents? Well, it's two things. Theta, which is represented here in this column here, or it's also known as time decay, and implied volatility. So here's theta. It's 1.2, we'll call it. This theta represents per share. And since an option contract controls 100 shares, we need to divide this number by 100. So 1.2 divided by 100 is just over a penny. So we've got 65 cents plus just over a penny. So we're up to 66 cents that makes up of this 90 cents. So what is the rest of that 24 cents between 66 and 90? That's where implied volatility. Implied volatility is the relationship of supply and demand of the underlying security. Implied volatility is one of the most key assets that we can use as option traders to put in our advantage. You could think of implied volatility like this. I remember whenever I was young, there was those little Furbies that like were fuzzy and they talked and they said, nom, nom, nom. You could feed them, press their little tongue. And during Christmas time, those Furbies, I don't remember how much they were going for. We'll say 90 bucks selling at Toys R Us, right? Ooh, I'm dating myself. Toys R Us is going out of business. Selling at Toys R Us, but because every parent wanted them for their kids during Christmas, you could find those Furbies on eBay for 3, 4, 5 times more than what they were selling for. Why? Because the demand was high and the supply was low, and that fluffed up the value of that Furby. Implied volatility is the same aspect inside of options and stocks, is that whenever the supply and demand ratio get off, where the demand is high and the supply is low, we see an increase in value, a future estimate of that stock option. Inversely, is that whenever the supply is high and the demand is low, we see a decrease in that value or that inflation of the options premium. So guys, these are the three things that make up an options premium. Again, it's intrinsic value, which is the difference between the strike price of the contract and the price of the underlying security. Then it's implied volatility. It's that supply and demand ratio. And then lastly, it's time decay, or theta, which is the rate of decay of that options premium as it gets closer to expiration. Download the Lingo cheat sheet. Until then, I'll see you in the next video. Let's build that legacy.